Well, basically another day of just trying to hang on, but there was the additional complication today, or additional influence of the day on which the Fed meeting minutes come out. They come out in the afternoon of the day on which they come out, um, uh, during the trading hours, in other words, so they have an immediate influence on the trading. They tend to have a positive influence on the trading because the Fed is, as noted before, at least in effect, obligated to talk in positive schmaltzy terms all the time in the context of the law against recessions to try to keep things going. The Fed meeting minutes are usually in that context as well, even when the times aren't so good. So what ended up happening today was that the market first went up, then it came back down again gradually for hours, waiting for the Fed meeting minutes to come up, pretty much came down to the bottom again. Then the Fed meeting minutes came out, and the way they were interpreted, bearing in mind that Wall Street is always looking for good news, even if it has to kind of interpret things in order to come to that conclusion. The Wall Street traders interpreted what the minutes said, that even though the minutes confirmed what Fed Chairman Powell has said along the way in recent times, that they intend to do, most likely intend to do, half-point rate increases at coming meetings for as long as necessary. The meeting minutes also indicated that if necessary they will have some flexibility in that, okay, which by the way the Fed has talked about verbally as well so far in the past. In other words, it was nothing new per se. But the reason for that in the first place is that the Fed is repeatedly trying to walk that fine line lately between raising interest rates enough and fast enough to quell inflation, yet at the same time not doing it so quickly that they induce a recession, bearing in mind that the law calling for full employment at low inflation is effectively a law against recessions. In other words, ever since that law was passed, recessions are illegal, nominally and officially. Okay? So the bottom line is they effectively have a legal mandate to try to avoid recessions, and really not just try, to actually do so. So whenever they're in the mode of trying to tighten monetary policy in order to get conditions back to neutral, they in effect are required to try to make sure they avoid a recession in the process. That's why there's been so much talk lately of walking a fine line to try to make that happen. To my mind, I mean, I knew we would eventually get to the point where it would be very difficult to do that. And to my mind, talking about walking a fine line is just a positive way of saying the same thing. Oh wow, this is not going to be easy. More accurately, it's going to be very difficult at best. Okay, but because the minutes indicated some degree of intended or anticipated flexibility on the part of the Federal Reserve, if necessary, along the way, bearing in mind that the Wall Street traders ultimately, more or less near term at least, are primarily concerned about interest rates because that affects them more directly than they are about inflation. Okay. If they hear something like, oh, we may have flexibility in how we raise interest rates down the road, the Wall Street traders say, hoorah! That's exactly what happened this afternoon. The market exploded upwards, blasted upwards, near term. By near term, I mean ultimately intraday. I'll complete that thought in just a moment. It's not complicated, but one thing at a time. So up it exploded. Okay. The S&P 500 made it almost back to 4,000 in the process. The Dow made it back above 32,000 for the moment, briefly, temporarily. But then later in the day, fairly late in the day, the markets started coming back down again. and by the end of the day, they were coming down pretty quickly. Okay. Looks like it was the beginning of a down move again, but the markets did close well above zero. In other words, it ran out of time for going down more for the time being. That doesn't mean it'll go down more first thing in the morning. There are reports that come out many mornings. There could be a report coming out tomorrow morning that will affect it in the up direction again. This is not uncommon. Okay, but the point I want to make here with regard to the up move that happened in the afternoon in response to the Fed minutes was it turned into an absolutely classic three-wave corrective move up, and the beginning of the impulsive downturn that would come after that if it's a corrective move up, in other words, in the case of a corrective move up, was beginning to form already. Came down slowly at first, but it was coming down pretty quickly by the end of the day. It looked like the initial part of an initial third wave down again. Okay, the thing I want to emphasize here yet briefly, in terms of the detail level quality of the three-wave move up, it was not a perfectly formed three-wave move up. Okay, it was close, but it was not a perfectly formed three-wave move up, because it was more dramatic than they usually are. Okay, the middle wave of the three waves, which is the corrective wave within a corrective move, okay, it was smaller than it usually is, quite a bit smaller actually than it usually is. The two impulse waves to the upside were way out of proportion to it, way bigger than they should normally be. Okay, it was a very tiny corrective move in the middle, but it was there, okay, very definitively there. It was a valid three-wave move, corrective move to the upside. It was just not as proportional as they normally are. The reason I'm putting emphasis on this is simply to point out that the likely reason why it was so impulsive compared to what a corrective move up normally is, in other words, the impulsive waves were the big waves in comparison, was because of the influence of the positive talk of the Fed. You know, there was more of a hoorah sense, more of a hooray sense to the move on the way up, and it was also steeper than they usually are. The problem is it didn't last. It didn't even make it to the end of the day. Actually, strictly speaking, not even close. Okay? It ended well before the end of the day, and then the market started coming back down again, and before we even hit the closing bell, the market was already coming down hard. It was still well into positive territory for the day, but it was coming down hard by then already. And in the process, it almost went below Dow 34,000. They panicked it off of that level again near the end of the day. When it got there, it bounced up from there again. But the S&P 500, which never quite made it to 4,000 to begin with, closed well below that level again. Now, they panicked up at the end of the day too. It's not that it closed at the low of the move, but it was nowhere near 4,000 anymore. Okay, so the bottom line is that the market had a rather erratic day, only a little bit of near-term positiveness when the Fed meeting minutes came out, apparently based on this interpretation of, oh well, you know, hooray, 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 it's more positive than we thought it would be. It looks like the Fed might be flexible after all. The problem with that idea is that if the Fed doesn't hit their own interest rate hard enough, fast enough, inflation will continue, and so they will have the problem from that side. Okay, in other words, under the circumstances, full employment at low inflation is a contradiction in terms. And apparently, after this initial, positive reaction on the part of the Wall Street traders, even before the end of the day yet, they realized themselves that, oh, wait a minute, how is this really going to fit together in reality? And down it started coming again. Okay, but that is just a guess. The reality is, ultimately, the Wall Street traders are always going to have to face reality. There's no way around that in the end. And it looks like, in this case, they didn't even make it through to the end of the day before they realized what reality actually looks like and started reacting accordingly. I will briefly add too, yet with regard to the European markets, again using the German market as a benchmark, they were once again there trying to make sure they stayed above 14,000, and in the end they only just barely did so after coming down a ways again too. Okay, so it was basically just a repeat of yesterday in that regard, just hanging on for dear life. We'll see how it works out tomorrow as a result. One other quick comment about cryptos, using Bitcoin as the reference in general, because it's a popular one to use as a reference so far. They're basically just barely hanging on too. For a couple of days there, Bitcoin was hanging on right around 30,000. It's now back down well below that level, on around roughly the 29,000 level. I expect it to go down more too. Okay, but we will see what happens there. And as always, and as usual, in the end, the reality is what matters, what actually happens, not what I or anyone else for that matter thinks is going to happen. Okay, I focus on what has happened and what the likely results of that are for the future. Okay, but today was not, even though they did have that big fast bounce during the day and the afternoon, this afternoon, my point is the market was not particularly strong after all. And given the way it's been lately, I don't expect it to be particularly strong going forward, at least certainly not near term, and at the rate things are going, probably not even long term. But we will track it as it goes, and I will report accordingly. So we'll see how the rest of the week goes. We really only have one more day that really counts, Thursday. Fridays are always a special case, as I've noted before. That doesn't mean Friday will go well. There have been just lately, it's part of the reason I started doing these videos again, is that there have been multiple Fridays in the recent past that did the opposite of what a Friday normally does. Okay, which may well happen this Friday again too if the right things are going, but we can't be sure of that. But because it has been that way lately, that was a further indication of how weak the market is, and I reported accordingly, and I may well end up reporting that on Friday this week again too, but we will see. Whatever it is, I will be reporting it on Friday or early next week, depending on when I do the next video, after tomorrow, if I do a video tomorrow. So we'll see how it works out over the next few days and go from there.